Welcome back. This is the continuation of my earlier presentation on accounting for hire purchase. So in this second part, I will examine the actuarial method of spreading the hire purchase interest. Now, actuarial method. Under this method, hire purchase interest is written off by charging a fixed rate of interest on the outstanding balance at the due date of installment. Hire purchase interest is written off by charging a fixed rate of interest on the outstanding balance at the due date of installments. So under this method, this method can be solved with the use of annuity formula. P equals to A into 1 minus 1 plus R raised to power minus N over R, where P equals to cash price less deposit. R is the rate of interest per period. Rate of interest per period covered by the installment. A equals to A is the installment payable at specified interval. Installment payable at a specified interval. Then N is the number of installments. Number of installments. So that is the formula. We apply this to calculate the fair value. You calculate the fair value of the hire purchase. You'll be given the cash price, so you compare the fair value and the cash price. Whichever one is lower will be used. Where the fair value, the result you obtain, the value of P, where it is less than the cash price, then you use the fair value. And where the cash price is less than the fair value, you use the cash price. So the lower of the two will be used. So now you will need to set up an amortization table. Amortization table to calculate the hire purchase interest that will be recognized yearly. So let me have year one, your opening balance. Opening balance, finance charge or hire purchase interest. Hire purchase interest. Then you have the closing balance. So you set up an amortization table like this. Your opening balance, before the closing balance. Instrumental payments. Then you have closing balance. You use this amortization table where the hire purchase interest is payable at the end of the year, where the hire purchase interest is payable at the end of each of the period. Example, cash price 20,945 naira, initial deposit of 8,000 naira, 4 annual installments of 5,000 naira each, payable on 31st December Higher purchase interest is charged at 20% per annum. Calculate the higher purchase interest to be recognized in the statement of profit or loss for each year. So this is the question. Now you want to calculate the higher purchase interest. I've given you the format for setting up the amortization table. I told you that that format will be used to calculate the higher purchase interest to be included in each of the installments. Now, let's have the amortization table. Higher purchase, amortization table. So we have year, then we have four annual installments of 5,000 payable on December 31st each year. So we have 4 annual installments: 1, 2, 3, 4. Then we have the opening balance. Then we have higher purchase interest. Higher purchase interest, I are given 20%. You were told that is 20%. You were told higher purchase interest is charged at 20% per annum. 20%. Then we have instrumental payments. Then we also have the closing balance. So, year 1, the opening balance. We were given the cash price of 20,945, an initial deposit of 8,000. So when you subtract, you have to net the two balances to get the opening balance, because the deposit that was made outrightly will not attract interest again, since deposit was made at the inception of the hire purchase transactions. That deposit that was made will not attract interest. Therefore, we have 20,945 minus 8,000. So we have 12,945. 12,945 you subtract. So that will be used as our opening balance. 12,945. Your higher purchase interest at 20%. Calculate 20% of that. You have 2,589. 2,589. Then instrumental payments. How much is the annual installment? 4 annual installments of 5,000 naira. So installments of 5,000. You subtract the installments. So if you have 12,945 plus 2,589 minus 5,000. So then you have 10,534. This plus this minus this will give us this. This closing balance in year 1 will be the opening balance in year 2. 10,534. You calculate 20% of that, it gives us 2,107 approximately. 106.8, which is 107. The installment is 5,000. So this plus this minus this, plus 10,534 minus 5,000. Then you will be left with 7,641. 7,641. That is the closing balance. The closing balance becomes the opening balance in year 3. 7,641. Then calculate 20% of that. you'll be having 1,528. 528. Installment is still 5,000. Annual installment of 5,000. So let's sum up this. This plus this minus this. 7,641 minus 5,000. Then the closing balance will be 4,169. 169. The closing balance in year 3 will be the opening balance for year 4. 4,169. And the instrumental payment is 5,000. The difference between the opening balance in year 4 and the installment, we have 5,000 minus 4,169. We have 831. And if you calculate 20% of 4,169, 20% of 4,169, 20% of that gives us 834 approximately, equal to 834, which is greater than 831 by 3. It's greater than this by 3. This is greater than this by 3. The difference of 3 is as a result of rounding off, so it's a rounding off error. In year 1, you have to calculate the higher purchase interest to be recognized in the statement of profit or loss for each year. Let me just draw up the statement of profit or loss extract. Let's have our statement of profit or loss extract. Statement of profit or loss extract. We have year 4, year 3, year 2, year 1. So we have finance cost. Under finance cost, after our operating profit, in accordance with IAS 1, you have your finance cost, that is the higher purchase interest. 2,589 year 1, 2,589 in year 1. In year 2, 2,107. 2,107. In year 3, we have 1,528. 1,528. In year 4, 839. 839. So that is the solution to this question. This is the end of the part 2. The part 3, I will examine the accounting for hire purchase in the books of the hire purchase buyer, that is in the books of the vendee, where details accounting entry will be provided. Then we call it some work example.